Greetings, everybody. Welcome to the latest e-newsletter. We're going to have to get used to a lot more volatility in the markets, and we're going to have to get used to a lot of uncertainty. Let's just have a quick look and see and just kind of account for where the markets are right now. All of the stuff I share over the years with my clients and subscribers to this e-newsletter, I always like to emphasize the importance of a long-term view with your investments. If you have a short-term view, you're doomed to failure every single time. If you have the proper asset allocation to match your goals, you will do well. So with this e-newsletter, I'm including a couple of interesting posts. One is a recent podcast that Justin and I did, just talking a little bit about current events such as the tariffs and basically investing during a trade war. What can we do about it? I'm also including my newest blog post, Why You Should Avoid Stocks. I'm going to also add one of my classic blog posts from originally years and years back that I keep revising every once in a while, and that is my first aid kit for volatile markets. And so this I last updated August of 2024. That was the last time we had a decline in the markets as big as the one we're currently in. And at that time, I believe it was about a 7% drop below the all-time high. As I'm recording this, the S&P 500 is currently down 6.6% below its all-time high. So what does that mean? Is this something really unusual that we should be really worried about? Well, history tells us no. History tells us this is actually completely normal and to be expected. There is no future in which the markets are no longer volatile, where nothing can go wrong, and we simply see a steady uptrend. Steady uptrends can be had in much less risky investments. When you own a GIC or a fairly secure bond fund or something like that, you'll typically not see the same type of volatility as in the stock market, but that comes at the cost of lower returns. And really, rather, it's the higher expected returns of stocks that come with the cost of higher risk. There is no way that you get one without the other. If risk was much lower in stocks, more people would buy them, their prices would be even higher, and then as you're getting into them, your expected return is lower because they have much less to rise, basically. Crashes are completely normal. And we're not going to crash yet, but who knows? A 5% or greater decline, like the one we are currently in, historically has happened 3 times per year on average. Now, a 10% decline or greater happened once per year on average. When I wrote this, or when I updated it last, we saw a decline of about 8% in August of last year. So right now it's March of 2025. It's been more than 6 months since the last decline. We're one overdue for a 5% or greater decline. And since it's been quite a while since our last 10% decline, we haven't had one since we came out of the bear market in 2022. We're actually kind of overdue for that as well. And my thinking is, the quicker the markets go down, the quicker we get to that, and the quicker we get to the point of time, whenever that is, when markets eventually turn around and continue that long-term uptrend that they've been on for many, many years. Included in this newsletter, actually, in my best read section, there is a great article at the UBS Global Investment Returns Yearbook for 2025. It now has 125 years of history of the markets, global markets, and looking what they've done over the many, many years. And it goes through a number of other key insights that come from their 400-page report that they put out each year. We very possibly might see a worse than 10% decline, worse than 15%, worse than 20%. And if we don't see it this year, we'll see it sometime in your investing lifetime. There is no future where we do not see another 20% decline. It will happen, probably within the next 5 years, just based on the last one having been 3 years ago now, 2022. And one other thing to remember is when the bottom happens, nobody will know. We don't know if getting out of the markets right now will help us avoid worse declines, or if we basically would be getting out at the very bottom and the markets recover tomorrow. The extreme unpredictability of these markets under this president give way to the fact that tomorrow he could say that he's not going to do any tariffs and everything turns around and it's all hunky-dory. We don't know. He's just that unpredictable. And keep in mind that while we have a very unpredictable president south of the border, he's not president forever, and the businesses that operate and that have operated for many years, that create goods and services that the consumer uses, businesses use, they're going to continue. There's nothing that's going to stop them from continuing their operations, continuing to make profits over time, growing shareholder wealth, despite what is happening in politics. So this percent off high or drawdown chart, if we zoom out a little bit, we look back and we see the decline we had in August. We're not there yet. If we go back 10 years, we see what kind of markets we experienced in the last 10 years. Certainly got much worse in 2022, much worse in 2020, and even significantly worse during the last tariff war in 2018, when the markets bottomed at almost just about 20% negative. Now, this is a very negative chart. It is a drawdown chart. It's only looking at the worst of the markets when things go down. The top line basically is the all-time high. If we turn this into a normal stock chart, we get this. That is what the markets did over 10 years. 173% return, works out to a 10.57% annual return, and that's not including dividends. Now, should everyone be invested 100% in U.S. stocks? Absolutely not. I wrote about that in my last 2 blog posts. Anyways, when we look at long-term charts like this, line charts of what the markets did over X number of years, this is 10 years. If I zoom out even more, this is the S&P 500 going back to 1950 something. This obviously tells us that it makes a lot of sense to invest in stocks, U.S. stocks in this particular case, if your time horizon is 70 years. No doubt about that, right? Not all of us have 70-year time horizons. Maybe Warren Buffett does, but I hope we can all live to 94, whatever he is. By the way, I have Warren Buffett's latest shareholder letter also included in my newsletter this month. And I find it is a fantastic read as always. What I really like about how he talks about the markets and stocks is forget about all that trading stuff or the volatility of the markets and what's going on, all that noise. He talks about them as businesses. He owns a bunch of profitable, cash-flowing businesses. And if we can all take that perspective when it comes to investing in stocks, it'll lead us to a lot better decisions. We're not trying to buy this line that goes up and down and try to get out of that line before it goes down, or even let it worry us. Again, if stocks are down, whatever they are now, 6.6%, the underlying businesses, they are still doing what they're doing. Rather than looking at a line like this, one of my favorite charts is this one right here. Apologies to my clients who saw this on a recent newsletter video, but I'll go over this again. This is, again, one of my favorite charts, just because it gives a lot more insight into the experience of investing over time. Now, this chart, if you've never seen it before, it is based on the matrix chart that Dimensional Funds puts out every year. This was put together by Interact FA. What they do is they take the data and they create this nice visual tool, great for advisors to use to help sort of explain long-term investing. Now, how this works, on the very edge of the diagonal, you have 1-year returns. Every rectangle is just 1 year in the market. So now we've got 2024 on here, where we saw a 25% return. In this case, the index we're looking at is the FAMA French Total U.S. Market Research Index from 1927 to 2024. As we move up from the edge, we have each rectangle representing a compound return of several years. The very top line here, that is the years leading up to 2024. So if we go all the way back, all the way to the left here, that is 1927 to 2024, during which U.S. stocks returned 10.2% annually. We can look and see what effect inflation had on these numbers. So once we figure in inflation, that return comes down to 7%. I just read the report from UBS that's also linked in my email, and they had a return of 6.6% after inflation for U.S. stocks long term. They have a time horizon of 1900 to 2025, whereas this is a bit shorter term, only going back to 1927. So one other thing to make note of here is you can see the general illustration here is short-term red occasionally. There's some dark green, which means a high return in a single year, but there's some red and some dark red as well, and some blotches that go on for years and years and years. But once we look longer term, once we're a little bit higher in that chart, if we completely ignore everything here less than about 15 years, so this diagonal that I'm moving my mouse along right now is approximately that 15-year range. Beyond that, it's all green, just different shades of green. You have some lighter shades of green, so if you happen to invest in the markets towards the end of a really strong period of time, right before they got really nasty, the markets, your long-term return was not so great. Here we look at 1969 to 1994, where the real return after inflation of stocks was only 4% annually. So how did that come about? That came about from investing your money in 1969. And 1969 here you can see was the first really red year of a period of time that was pretty negative for stocks. So you basically got into the stocks right after this really strong period of time, 1950s and 60s. The 70s were a sort of a lull of a time period when growth stocks didn't do so well anymore, and so on and so on. And then, of course, we had the 80s and 90s, which were really fantastic. What I really want to kind of show here, too, is the importance of making sure your investments are tied with your financial planning goals. So if you have a time horizon of 1 to 5 years, I just recently saw someone online asking, what should they do to invest some money for 1 year? What ETF should they buy? And a lot of the people commented rightfully, you don't want to buy any type of ETF. You want to put that money in a savings account. This is someone who's looking to buy a house in a year. If you're investing for less than 5 years, it's pretty much a crapshoot. Just lots of different shades of green and red. No advisor, no portfolio manager, economist, market strategist, no one can tell you when these red blotches are going to happen. When we go beyond that, even 6 to 10 years, there were some long periods of time of bad returns. Periods of time where you were invested for as much as 15 years and your after inflation return was negative. Still, that's still not a time period to be investing 100% in stocks. Beyond that, 11 to 15 years looks a little bit better. Beyond that 15-year range, every 15-plus year time horizon for, in this case, U.S. stocks was positive. If we look at Canadian stocks, and again, I'm still keeping it after inflation, generally speaking, beyond that 2008 to 2018, which is 11 years, beyond that range, every period of time was positive. Lastly, my email includes a couple of more articles in the Goodreads section. I admit it's a bit longer this month than previous. What I'm sharing in the Goodreads section, what I'm reading on a monthly basis, reading, watching, listening to, probably the top 10% I share in my Goodreads sections. If I include it there, I'm including it because I think it's a really important read for you, a typical Canadian investor looking to inform yourself about investing or personal finance. I think you should read all of it if you have the time. The other thing I really recommend everyone who gets this email reads is my latest scam, schemes, and terrible financial advice. In this one, I'm including a very current scam that's going on right now that's scamming Canadians as we speak, especially during RSP season or after, as people are looking for GICs and they're shopping around for GIC rates. I remember my time at the bank when I was in a retail bank having these customers that come in and ask for our rates, and then they went across the street to CIBC and then to Royal Bank, and just went from bank to bank, always bringing their money from one place to another for the best GIC rates. Those people are still out there, and if you know them, warn them, because what's happening right now, it's not a fun story. It's not even that obvious of a scam. I can totally see people falling for it. People are basically going online and doing a Google search for GIC rates. But instead of finding legitimate sites like RateHub, they're finding fake GIC dealers. People who basically pretend they are, in this case, PC Financial. And what people are doing is they're actually sending money via wire payment to scammers who've created this site, who are sending them agreements with letterhead that all looks legit, thinking they're buying GICs with a GIC dealer. And anyways, this is another reason why at the bottom of each of my emails, I also include the current GIC rates. That list that you see on there, and I'm not really trying to sell GICs. You know, I'm not a big fan of GICs. I think they're terrible for your long-term financial plan. Just as I showed you in these charts here, you're guaranteed to have suboptimal returns if you're investing for more than 5 years and putting all your money into GICs. But it's important to know what are the GIC rates at any given time. Because if one of these people that was scammed got my email and knew that the best rates right now for 5 years are in the 3s, they've come down since a year ago, then they'd know that someone online offering 6 to 9% is definitely scamming them. And that's always the case. If someone is offering a rate like that for an investment that they claim is low risk, it is always either a scam or, best case scenario, it's just a risky investment and you're not taking into account how risky it is. So if you know anyone in your life that could be vulnerable to this type of scam, make sure you are reaching out to them and letting them know that this is happening. If they watch the news every night, they probably already know, but that is the key thing, is knowing what's going on out there. And also knowing GIC rates today are in the 3s. Bank of Canada lowered rates a bunch of times last year. You're not getting 6% anymore. So again, that's what makes this scam so sneaky, because a year ago it was realistic to be getting 6%. So that didn't seem like, like I said, if it's a high rate of return, it's a scam. A year ago, 6% on a GIC was not. It was actually offered online by several legitimate GIC issuers. But today it is a scam if someone's offering you that type of a rate. So with that said, at the very bottom of the email, you'll find some words of wisdom. I always like to include a quote down there, something finance related. This one comes by way of Morgan Housel. He just tweeted it a few days ago, and I just thought I have to include this. For most investors, 99% of good investing is doing nothing. The other 1% is how you behave when the world is going crazy. So I'll leave you with that.